Hello all, today I will be covering budget 2027, which is a Yuva Shakti driven budget for all the aspirants for their respective preparation. So let's begin. The size of budget for financial year 2027 is estimated at rupees 53.47 lakh crore. In the receipt side, the biggest revenue or receipts are coming from the revenue receipts, that is 35.33 lakh crore, which comprises of tax revenue, which is income tax, GST and other taxes, that is 28.67 lakh crore, and other non-tax revenues of 6.66 lakh crore. Other non-tax revenue comprises dividend, fee, fines or penalties imposed by the government. On the capital front, the overall capital receipt will be 7.14 lakh crore, which will be covering the recovery of loans and other receipts of 80,000. These other receipts are mainly disinvestments or monetization. Disinvestment through the IPO or FPO of the existing PSUs or government undertakings. And monetization is mainly done through innovator REITs or say toll operate transfer models. Various models are there through which government garners funds. These are innovative ways of financing. So this year government is targeting 80,000 crore other receipts, that is nothing but disinvestment and monetization receipts. If you see the last year, 47,000 was the target for those other receipts, against which the revised estimate is 33,000 crores. So that is a remarkable achievement for the government. So total receipts are 53.47 lakh crore. On the expenditure front, the largest expenditure is there on the interest payment, that is 14 lakh 3,972 crore. And besides that, the second highest expenditure is being emphasis has been given on capital expenditure, that is 12.21 lakh crore, against the 11.21 lakh crore of the last year. So, however, the capex target was missed by around 25,335 crore for financial year 2026. So, budget size is of 53.47 lakh crore. If you see the public capex, it was just 2 lakh crore in the year financial year 2014-15, and whereas an allocation of 11.2 lakh crore was given in the budget estimate 25-26, and in 26-27 it increased to 12.2 lakh crore. Means from financial year 25 to 27 there has been a growth of around 10 lakh crore in the capex or expenditure on account of capital account. So to fund those expenditure, the revenue receipts are there, other capital receipts are there. However, for a country like India, which is a developing country or in the phase of becoming a developed country, debt is required for various aspirations or for our developmental needs, so which cannot be covered or recouped through the various receipts. So we need to have our own, we need to avail debts to fund that development activities. So that's why we have a borrowing of 16.95 lakh crore budgeted for the year 27. So these borrowings are called fiscal deficit. So fiscal deficit is an operational instrument for debt targeting, that we know that we require a debt, we require fiscal deficit or borrowing to fund the developmental activities, but at the same time we need to take care of our fiscal health. That should not be the case that fiscal deficit breach a comfortable target level. So the government had committed in the year 21-22 that they will keep the fiscal deficit at 4.5% in the year 25-26. So that promise has been kept, and revised estimate says for the year 25-26 the fiscal deficit target was 4.4%, and against that financial year 27 has stated that it will be capped at the level of 4.3%. So the quality of a budget can be known through revenue deficit. So revenue deficit, if you see for last years, it has been gradually decreasing from 1.7 to 1.5, and again government has target at the same level of 1.5% for the revenue deficit. However, the effective revenue deficit, if you see, it was 0.9% in 25, 0.6 in 26. The government has now targeted to achieve effective revenue deficit of 0.3%. And besides revenue deficit and effective revenue deficit, the amount of expenditure being created for capital account, means for creation of some asset, that is capital account expenditure, you see that expenditure has been increasing year on year. So these data, these figures shows that how the quality of the budget has been maintained. Now, the gross market borrowing are up from 14.8 lakh crore from financial year 26 to 17.2 lakh crore in financial year 2027, and the net market borrowing will be around 11.7 lakh crore this year. The net market borrowing, gross market borrowing differs because net market borrowing takes into account the repayment of borrowing and repayment of other loans availed by the government. So the net market borrowing will be around 11.7 lakh crore. However, the gross market borrowing will be going up from 14.8 to 17.2 lakh crore. Coming to the major expenditure item, we already discussed that the interest is the single most largest interest item or payment item, that is 14.03 lakh crore. Beside that, the transport expenditure, if you talk about the roads, your NHI, this transport item is 5.98 lakh crore, and at third place comes the defense, that is 5.95 lakh crore. That is the expected or budgeted expenditure for major items. Now, coming to the ministry wise, if we see the ministry wise allocation, the agriculture ministry has a budgeted estimate to incur 1.40 lakh crore, then chemical and fertilizer industry 1.77 lakh crore, in consumer affair and food public distributions 2.39 lakh crore, and defense had the, we have already stated about that item. Some other expenditure also there. So in the ministry itself had an budget allocation of 7.85 lakh crore. In finance, this 19.72 lakh crore, the highest budget allocation is to the Ministry of Finance, because the interest payment is taken care by the Ministry of Finance. That's why they had the highest allocation. Then power, new renewable energy, they had this budgeted estimate to incur around 29.99 thousand crore rupees. Coming to railways, it's for 2.81 lakh crore. Your road transport highways around 3.09 lakh crore. Your rural development is 1.97 lakh crore. So we saw that our overall transport expenditure were around 5.9 lakh crore. So if you add railway and roads, so you will come to know that the transport comprises both. So this figure will tentatively it will match. But one point you might have noted that in Ministry of Power or Ministry of New and Renewable Energy, the budget allocation has been lower as compared to the other sectors, though the government has been emphasizing of the power sector. So historically, why the budgetary allocation is lower in these ministries? So the reason is the business model of, if you see the power sector, it is a more of a tariff based revenue model. So cost based pricing is there. So the discoms or these power companies, they are able to recover it from the customer. That is the first thing. Second thing, electricity is more of a state subject. So since the electricity is a state subject, the state government budgets are also there. And third point is, government is also emphasizing the power sector to participate in the to participate in financing the power or new and renewable energy. So that's why we have PFC, REC, and even banks, they are funding to the power sector. So that's why the allocation in the power and new and renewable energy sector has been lower as compared to the other ministry. So budgetary allocation in power sector is mainly for the viability gap funding, for grant subsidies, or for sovereign guarantee. So these are the points which you need to account. We'll talk about the outlay on major scheme at the last part of this budget document analysis. So coming to the fiscal matters again, we talk that debt is required for the purpose of development, but it should not be the case that we as a country, we should not over leverage. When a company over leverages, so it may have impact on the company itself. It may have a positive impact, a negative impact at the same time. If there is a pro-cyclical impact, then the company doesn't have any revenue to pay the interest, but the debt, they need to pay the interest because it's a fixed obligation. So in that case, your leveraging is a worst thing to happen for any particular company. So the same case goes to a nation. We need to have a controlled debt, but that at the same time, debt is required to fund the development. So we need to have a trade-off between these two things. So public debt is a good thing, but it has some adverse effect, that is the financial repression. Financial repression in a way, suppose government issues securities, so these securities are subscribed by various institutions, and government or RBI, they will want that the government securities should carry a lower yield. So if the institutions like bank or insurance companies, if they invest in those government securities which carry a lower rate of interest, so the depositors or who provide funds to those institutions, they will only have a lower share in that particular investment, because that investment is not making a big money, it's just giving a coupon of say 6% or 7%. So the investors should not expect a higher return from such investment, so it is giving result to the financial repression. Second is crowding out of private investment. Crowding out of private investment means when the banks, they are infusing their money in those securities, they have less amount or capital to provide for private players, so it results in crowding out of private investment. Third thing is it gives rise to inflation in a way. If the government finances the deficit by issuing bonds, means borrowing from the market, so it creates demand for funds for private sector, because there is a crowding out effect. So when there is less liquidity in the market, the higher interest will be charged by the banks, which results in higher cost of production, and at the end of the day what will happen is a higher inflation. And at the same time, since the inflation will be higher, yield will rise, and there will be valuation loss for all the market driven security in the secondary market. So these are some of the adverse effects of the higher public debt. So fiscal consolidation, if we talk about the fiscal consolidation, we have discussed the fiscal deficit part earlier, that fiscal deficit is nothing but the borrowing which is made by the government of India to fund the debt, to fund the developmental activities. It is nothing but the gross borrowing or the borrowing availed by government of India. So central government will target to reach debt to GDP ratio of 50 plus minus 1% by 2030. That is the new anchor for the government. Now debt to GDP ratio is estimated at 55.6% of GDP in budgeted estimate 26-27 as compared to 56.1, means 50 bps down. In revised estimate 25-26, the fiscal deficit has been estimated at par with budgeted estimate of 4.4% of GDP. In line with the new fiscal prudence path of debt consolidation, the fiscal deficit in budgeted estimate is estimated at 4.3% of the GDP. Coming to the 16th Finance Commission recommendation, the government has accepted the recommendation of the Commission to retain the vertical share of devolution of 41%, and the 41% plus 1% is also there for this state of Jammu Kashmir. Sorry, the Union Territory of Jammu Kashmir, and the provision of 1.4 lakh crore to the state for financial year 27 as Finance Commission grant. These grant will include rural and urban local body grant and disaster management grant. So you see the deficit trend. So over the years, your deficit has reduced. Your fiscal deficit, if you see, it has reduced from 6.5 to 4.3%. Means from 22-23 to we are talking about 26-27 budgeted estimate. That your revenue deficit, you see the quality that has improved, because your revenue deficit has reduced from 4 to 1.5. Your primary deficit is also reduced, and your effective revenue deficit means, and the effective revenue deficit, if you talk about effective revenue deficit, means the revenue deficit is like you have revenue expenditure in excess of your revenue income or your revenue receipts, but some of those your expenditures, they are also getting at the end. You see the end use in creation of some capex, so effectively it is a capex only. So that if revenue expenditure is being utilized for the creation of some capex, that will be reduced from the revenue expenditure, and will get effective revenue deficit. The Finance Minister of India gave 3 kartavyas while presenting the budget, which are to accelerate and sustain the economic growth, to fulfill the aspirations of our people and build their capacity, and to align with the vision of Sabka Saath Sabka Vikas. So these are the main 3 kartavya laid down during the budget speech. So there has been a 3-fold approach required for a supportive ecosystem. The FM presented that over 350 reforms have been rolled out after Independence Day, means August 2015. These include GST simplification, notification of labor codes, rationalization of mandatory quality control orders. High-level committees have been formed, and in parallel, the central government is working with the state governments on deregulation and reducing compliance requirement. Coming to the industry, manufacturing or MSME segment, that is the most crucial part of the budget that everyone look for, that what has been there in the budget for the economy, for the manufacturing, for the agriculture, for the startups, for the MSME. So the government has announced the Biopharma Shakti. Shakti, that stands for Strategy for Healthcare Advancement through Knowledge, Technology and Innovation. It says that India's disease burden is observed to be shifting towards non-communicable diseases like diabetes, cancer and autoimmune disorders. So these biological medicines are key for longevity and quality of life. So to develop as a global biopharma manufacturing hub, the Biopharma Shakti schemes has been proposed with an outlay of 10,000 crore over the next 5 years. The aim is to build the ecosystem for domestic production of biologics and biosimilar. In manufacturing, the emphasis has been given on the India Semiconductor Mission 2.0 to fortify the supply chain of semiconductor industry. Then comes the manufacturing electronic component manufacturing scheme. It was launched in April 2025 with an outlay of 22,919 crore. Now the outlay is proposed to increase to 40,000 crore to capitalize on the momentum as the scheme has been doing well. So the major leverage emphasis has been given on manufacturing activities. To support the mineral-rich states like Odisha, Kerala, Andhra Pradesh, Tamil Nadu, a dedicated rare earth corridor will be established to promote mining, processing, research and manufacturing. And at the same time, to enhance the domestic chemical production and to reduce the import dependency, a scheme will be launched to support the states in establishing 3 dedicated chemical parks through a challenge route on cluster-based plug-and-play model. Now, what is the importance of manufacturing sector? As you have seen that for the pharma, for the chemical, for the semiconductor industry, for the electronics or for the rare earth, so many new initiatives have been taken care by or rolled out by the government of India. So you see, for any country to truly grow, manufacturing can't be an afterthought. Every major economic powerhouse figures this out very early. If you talk about the US, they built their dominance by building more factories during the World War II, which provided employment. And at the same time, if you talk about China, they followed the similar playbook, using manufacturing to absorb labor, boost exports and climb up the value chain. So this year's budget doesn't bet on a single headline grabbing scheme. Instead, it tweaks incentive across sector to make producing in India cheaper, easier and export finished goods a little more attractive. Now coming to the MSME sector, MSME, they have been considered a cornerstone for a growth of an economy. They are like growth engine for an economy. To support the MSME, the 3-pronged approach has been deployed by the government of India, and the first one is equity support. A dedicated 10,000 SME growth fund is going to be introduced to create future champions and incentivizing enterprise based on certain criteria. At the same time, there will be a top up on self-reliance fund which was set up in 2021 with 20,000 crore to continue support to micro enterprises and maintain their access to risk capital. Risk capital is an equity infusion by the government or say by the private sector to fund risky innovative assets or projects or costs. If you talk about this SRI fund, Self-Reliance India Fund, it was announced in 2021 as a part of Atmanirbhar Bharat package for equity infusion in those MSMEs which have the potential and viability to grow and become large units. So initially, the government announced that it will be equity of 50,000 crore will be infused, wherein the government will be contributing 10,000 crore and private equity will be around 40,000 crore. Now the government has said that it will be topped up by rupees 2,000 crore. Besides equity support, government has said that the liquidity support will be given through trades. That is around more than 7 lakh crores has been made available to MSMEs through trades model. So to leverage its full potential, 4 measures were proposed in this budget. That the trades has been mandated for the transaction platform for all the purchases by MSME from the MSME by CPSEs, Central Public Sector Enterprises. Then credit guarantee support mechanism through CGTMSE will be introduced, like GEM, link GEM with trades for sharing information and with the financials about government purchases from the MSME. So it will encourage cheaper and quicker financing. Then a trade receivable as asset-backed security will be introduced to develop a secondary market to enhance the liquidity and settlement of transactions. So these are the equity support, liquidity support, and government also talks about the professional support, that it has asked the Institute of Chartered Accountant, Company Secretary, and Cost and Management Accountant to develop a cadre of corporate mitra which will help MSME in meeting their compliance requirement at affordable cost. If you talk about the last year budget, the government what did it enhanced the threshold or benchmark for micro, small and medium enterprise classification, so that those entities can also get benefited from various initiatives or schemes of Government of India. So these revised threshold you may see from this particular table. At the same time, last year the credit guarantee cover was also revised, so that can also be pursued from this table. Coming to infrastructure, public capex, as we have discussed, the public capex has increased manifold. Now, one of the measures which is taken care by the government is the Infrastructure Risk Guarantee Fund is established to provide prudential, calibrated, partial credit guarantee to lender. So, through the National Credit Guarantee Trustee Company (NCGTC), this is likely to be implemented. They are likely to underwrite your development risk or say construction risk of that particular project or the infrastructure project, allowing banks and financial institutions to lend on easier terms. So this guarantee cost will be there, so that will be added to the borrowing cost, so the impact on lending rate will be minimal, but those lenders, they will be secured through this credit guarantee fund, which is established by Government of India to give support to own that credit risk. So the lenders will not be hesitant enough to support those risky infrastructure project. Now, real estate for CPSE through the setting up of dedicated REITs, Real Estate Infrastructure Trust, for asset monetization of CPSE, this will be established, and new dedicated freight corridor will be established. 20 new national waterways will be established over the next 5 years. Then carbon capture, utilization and storage was launched in December 25 to achieve higher readiness level in end use application across 5 industries sector, that is power, steel, cement, refineries and chemical. So this is in align our nation with the ESG norm. So that is also being taken care by the government. So an outlay of 20,000 crore is proposed in next 5 years, so that we can say that the end use is environment friendly. Tier 2 and Tier 3 cities, even temple towns, are India's engines of growth, innovation and opportunities. So for these CRE, means city economic regions, an allocation of 5,000 crore will be given over 5 years to develop them or to implement the plans on a challenge mode on reform come result based financing mechanism. 7 high speed rail corridors will also be established. A C-plan viability gap funding is going to indigenize manufacturing. Now coming to VGF, what is viability gap funding? So viability gap funding is budgetary support for infrastructure project under public-private partnership to make it commercially viable for private investors. So when a project is not commercially viable, the government makes it viable by infusing some grants or funds, because government thinks that even though the financial IRR may be less, but the economic IRR is positive for this account, because economic IRR takes into account the positive effect on the society as a whole, which may not have any monetary value as such. Then it talks about 2 lakh crore support to state under a scheme for special assistance to scheme for capital investment for providing 50-year interest-free term loan will be given to the state, and 15 archaeological sites like Hastinapur, Leh places as an experiential cultural destination, they will be developed. Coming to the finance sector, a high-level committee on banking for Viksit Bharat is proposed to be set up for making banks that takes care of our Viksit Bharat. Then to achieve the scale and improve efficiency in the public sector NBFCs, to begin with PFC and REC, the restructuring will happen. And here in the case restructuring means What happening is the consolidation of those PFCs. Then FEMA rules, they are being comprehensively reviewed to create more contemporary and user-friendly framework. A market making framework for corporate bonds, so that the institutions, they leverage the bond market with suitable access to funds and derivatives on corporate bond indexes. And that at the same time, the most talked about initiatives, so that our municipal corporations, they also tap the bond market for the development, that is to increase them the issuance of municipal bonds of higher value. Then if they issue a bond, single issue of 10,000 crore, 1,000 crore, then an incentive of 100 crore will be given to those municipal bonds. The current scheme under the Amrit, which incentivizes the issuance of 200 crore, will also continue to support smaller and medium towns, because they cannot raise bonds of 1,000 crore. So for them, the existing Amrit scheme will continue. Now coming to the tax arbitrage, the addressing of the tax arbitrage part. The tax arbitrage is gone when there is a buyback or of shares or dividend distribution. These both transactions will be taxed in the same way, so there will not be any arbitrage. So earlier what used to happen is the large core promoters, they often preferred buyback because the cost of acquisition of those shares was claimed as a capital loss. So those capital losses, they were utilized elsewhere, so and which resulted in a sharply reduction of their true tax rate. So now this will not happen. Small public shareholders meanwhile simply paid a slab tax rate on the deemed dividend. So this arbitrage is addressed. Coming to the security transaction tax, to which market responded that day, and it went down to some extent. That STT on option premium was raised to 15.15% from erstwhile 0.10%, and STT on futures so the biggest jump from 0.02% to 0.05%, almost 125% jump. So these all to be effective from 1st of April 2026. And now again, very important measure taken care by the government is that is the sovereign gold bond will be exempt from the capital gain tax only when the investors who bought them on the day one and hold them till maturity, only they will be eligible from capital gain tax. Means if you have bought a sovereign gold bond from the secondary market, then you will not have that capital gain tax exemptions. It's only when you subscribe it and you received sovereign gold bond and the primary market and from the government or RBI itself, then only you will get it, and you should hold it from the day one itself. Coming to the ease on doing business or emerging technologies including artificial intelligence, government took certain measures which you can read from here. Other initiatives, the most sought after, most talk after topic is what is orange economy. So orange economy is India's animation, visual effects, gaming and comic sector, because the government thinks that 2 million professional will be required by the year 2030. Means 20 lakh people, they will be employed in these sectors. So AVGC, that is animation, visual effect, gaming and comics content creator labs will be created in 15,000 secondary schools and 500 colleges. At the same time, high value agriculture, that is like coconut, sandalwood, cocoa and cashews in coastal area, they will be given more emphasis. So agate trees in northeast and nuts such as almonds, walnuts, pine nuts, they will also be supported. So the government will take measures to support those farmers who are engaged in cultivation of those high value agriculture. Now coming to the importance of agriculture, we have discussed the importance of manufacturing. Now the importance of agriculture is that in 1991 it contributed around 35% of GDP, and today it is around 18% only. But what has not changed is its importance in a way that half of India's population is dependent on or employed through agriculture, and that's where the challenge lies. The government has to find ways to raise farmers' income without endlessly increasing your MSP or subsidies, because that would eventually put pressure on public finance. We just discussed the adverse public debt effects. So what is the easiest route? The easiest route is in high value crop, because they will provide a higher income to those farmers who are cultivating those agriculture crops. So these crops generate more value per hectare per worker than staples like rice and wheat. That's exactly why, alongside measures to improve the animal husbandry and fisheries, the budget places a clear emphasis on high value agriculture. So this is a very commendable step taken in this budget. So what are the key risks? If we see, the budget focuses on the industry, academia and government, but there are certain risks involved in the budget, and these are more of a generic risk, that the poor monsoon or a climate disaster, it may jeopardize our inflation assumptions, because as of now inflation is well timed. Then tax receipt, they should be in accordance with the plan, otherwise again it will result in higher deficit, which will result in higher yield, higher inflation. Third is global uncertainties, there war or tariff, these issues are yet to be resolved, and disinvestment target of 80,000 crore going off track, because last year though the target was achieved to a great extent, but this year the target has been increased to a manifold. So that's why this is going to be checked whether it is being achieved or not. And then political uncertainties may be there, because then 4 state elections are upcoming. So that's how the budget has been presented. It has been a Yuva Shakti driven budget. It has given emphasis on manufacturing, infrastructure, on your agriculture, even your orange economy, your high value agriculture. These sectors have been suitably taken care of, so that it helps India to grow as a Vikshit Bharat. Now, as we discussed earlier, that we will be discussing the government schemes. So some of the government scheme, if you see, the S here means, if you see S here in this particular scheme, these are the centrally sponsored scheme, and C you see that is a central sector scheme. Now centrally sponsored and central sector scheme, what is the difference? Now in central sector scheme, 100% funds are provided by the central government, execution lies with the central government. Then generally the central sector scheme, they cover the areas which are in the union list subject, and higher budgetary allocation is there in the central sector scheme. And when compared to a sponsor scheme, they means the central government provides some portion, remaining portion is provided by, budgetary allocation is provided by the respective state governments. Then in central sponsor scheme, execution lies with the state government, and they are generally from the state list subject, and from the central government perspective they have lower budgetary allocation. So these are the difference between the central sector scheme and centrally sponsored scheme. You see the biggest allocation historically has been to the Pradhan Mantri Garib Kalyan Anna Yojana. Just for reference, I am again reiterating all these schemes. Though the Pradhan Mantri Garib Kalyan in Anna Yojana, it was implemented under National Food Security Act 2013. So it provides rice, wheat through public distribution system free of cost. It has been the scheme has been implemented since March 2020 as a under the COVID, and it also provides for 35 kilogram of food grains per family per month, and the aim is to provide food and nutritional security. It is based on principle of equity and inclusion, and then there are certain beneficiaries, eligible beneficiaries. For that you may refer to this link, that is www.myscheme.gov.in. For all these schemes you will come to know whatever measures have been taken care by the government of India. Now I need to point out and certain schemes. These are the existing schemes, and these are the new schemes or which have been rolled out in this financial year 26 or announced in the budget 27. So these are comparatively newer schemes. These are the older schemes. So in the older scheme, if you talk about Pradhan Mantri Surya Ghar Muft Bijli Yojana, the allocation has been from 17,000 crore to 22,000 crore. So government has been emphasizing on the renewable energy. If you talk about the Urban Challenge Fund, the increase has been manifold from 1,000 to 10,000 crore. Even if the viability gap funding for the BESS, that is battery energy storage system, that is again to take care of the renewable energy sector, it has also enhanced 10 times from 100 to 1000 crore. So these are the schemes which are already there, and government has been emphasizing on those schemes. But however, there have been certain misses. If you see the Pradhan Mantri Awas Yojana Urban and Urban 2.0, this was the budgeted estimate, whereas revised estimate is 33.49%. Means out of the budget allocation of this much of amount, 19,000 and 3,500 crore for the year budget 26, only 33.49% was spent. So this was a miss. In the rural Pradhan Mantri Awas Yojana rural scheme, only 59.27% was achieved, and Jal Jeevan Mission, against the budgeted estimate of 67,000, only 25.37% was achieved. If you see the Jal Jeevan Mission here, only 17,000 crore was achieved. So again, this year target is around 67670. So the aim should be the achievement of the budget. Now coming to the new schemes, the government has been focusing Rozgar or employment for the inclusion. So Manrega scheme, if you see the Mahatma Gandhi National Rural Employment Guarantee Act, that has been replaced by this VBG scheme, that is Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin. So this was this act VBG Act to 2025. It was passed in December 2025. So under the act, every rural household whose adult member volunteers to do unskilled manual work will be guaranteed a wage employment of not less than 125 days. If you talk about the Narega, so in the Narega only 100 days of unskilled work was provided, but in this scheme 125 days of unskilled labor work, at least those much of days work will be provided. If that is not provided, then some compensation will be given in lieu of those work. So this the budgetary allocation has been substantial in the Viksit Bharat Guarantee scheme, around 95,000 crore. Now Pradhan Mantri Viksit Bharat Rozgar Yojana, that is the allocation is 20,083 crore. So under the Pradhan Mantri Viksit Bharat Rozgar Yojana, which was rolled out in August 2025, it aims to create 3.5 crore in 2 years. It aims to create 3.5 crore jobs in 2 years, and financial incentive will be provided to the employer as well as to the employees. Employees in the form of EPF contribution, and employers in the form of some incentives if the employer remains there in the organization for at least 6 months, and some other criteria are also there. So government has been emphasizing for the employment, and so that the development becomes inclusive, the growth becomes inclusive, which may be called as a development. Then SME growth fund, we have discussed about the SME growth fund, the allocation will be around 500 crore. Then municipal bond, as we discussed, for the high value bond issuance, the incentive will be given. Then infrastructure is guarantee fund, that is I think likely to be implemented National Credit Guarantee Trust Corporation, Trust Company Limited, NCGTC. So in lieu of some credit cost or some guarantee cost, the bankers they will be given support by way of assuming development or construction risk by the NCGTC. So these are the various schemes, new old schemes, and other announcement of budget. So that's how I conclude my budget document. Thanks for patient listening.